Welcome to RegTech Real Talk, where we dive into the wild stories behind financial crime. I'm Jamahal.
And I'm Charlie. Today we're talking about what might be the most successful con in modern finance. A company that convinced the world to use its private currency, became one of America's biggest creditors, and somehow made money laundering a government-approved business model.
Charlie, when I tell people this story, they struggle to believe it's real. We're talking about a Caribbean shell company with 150 employees that makes more profit than Goldman Sachs.
That sounds mathematically impossible.
Right? Except it's not. They made $13 billion last year. That's more than BlackRock, the world's largest asset manager, with a workforce smaller than your average McDonald's franchise.
Okay, so what do they actually do?
They print money, literally. Digital dollars that millions of people use instead of real dollars. And here's the kicker. The US government not only allows this, they're now actively promoting it.
That sounds like the setup to a very expensive joke.
It gets weirder. This story starts with a traffic stop on a British motorway and ends with Donald Trump's family minting their own cryptocurrencies. But let me back up to November 2021, because that's when everything started unraveling.
I'm all ears.
So picture this, the M1 motorway heading into London. Police pull over this guy Fawad Sayedi based on a tip about drug money. They find £250,000 cash in his boot. Decent bust, but nothing extraordinary for UK drug enforcement.
Standard courier operation.
Exactly. Except when they check his phone, they find direct messages from Moscow. Not from a drug supplier, but from associates of this Russian woman named Ekaterina Zhdanova, who operates from a 97-story tower where Russia's most notorious cybercriminals reportedly work.
So British street-level drug courier has direct lines to Russian cybercrime networks?
But it gets stranger. Turns out Zhdanova isn't just any criminal. She's running what amounts to a shadow banking system for the global underworld. She's figured out how to instantly convert physical cash into digital money that can cross any border in seconds.
How does this work?
This is where it gets brilliant in a terrifying way. Russian hackers accumulate massive piles of digital money from ransomware attacks. At the same time, European drug gangs are drowning in physical cash they can't spend. So Zhdanova builds a bridge between them using something called Tether.
Tether being?
Digital dollars. Imagine you could email cash. No banks, no borders, no questions asked. One Tether token always equals $1, but it moves through the internet instead of banking systems.
So the drug dealers hand over physical pounds.
And Zhdanova's people give that cash directly to Russian operatives who want pounds for buying Western property or funding intelligence operations. Meanwhile, she transfers the equivalent value in Tether from Moscow to the British gangs who can then buy cocaine from Colombian cartels or convert it back to clean money.
That's actually pretty elegant. How long does this take to execute?
Minutes, Charlie, instead of days. And her commission was 3% instead of the usual 10% for money laundering. But most importantly, because the money moved digitally rather than through banks, it was almost impossible for authorities to track.
Almost impossible, but they did track it.
It took 3 years. Operation Destabilize became one of the largest financial crime investigations in British history. What they found was staggering. A network spanning 30 countries moving hundreds of millions. But here's the really disturbing part. The same infrastructure being used to clean drug money was also serving the Russian state for espionage funding.
Crime and statecraft using the same payment rails.
Exactly. And it all ran on Tether, which brings us to the company behind this digital money, because that's where this story gets weirder.
So who actually creates these digital dollars?
The company Tether was founded in 2014 by 3 crypto enthusiasts and a former child actor. They incorporated in the British Virgin Islands and set out to create a digital dollar that wouldn't fluctuate like other cryptocurrencies.
But hang on. Why would anyone want digital dollars instead of real dollars?
That's the genius of it. Think about sending money to your cousin in Lagos. Normally, you'd pay steep fees to Western Union, wait days for processing, and your cousin might get $450 out of your $500 after everyone takes their cut. With Tether, you convert $500 to digital dollars, send them instantly for just cents, and your cousin gets exactly $500.
So it's faster and cheaper than traditional banking.
Massively. Plus, if you live somewhere with currency controls or hyperinflation, Holding digital dollars protects your savings. It's like having a US bank account without actually having access to US banks.
Okay, so there's genuine utility for end users. But what's Tether's business model?
This is where it gets clever. Crypto exchanges and big traders need Tether because their customers want it. It's become the go-to currency for crypto trading. You can trade Bitcoin for Ethereum directly, but the biggest markets and cheapest trades flow through Tether as the middle currency.
So the exchanges need inventory.
Exactly. Large players, exchanges, brokers, institutional traders wire real dollars to Tether to get fresh digital dollars they can sell to customers. Tether takes those real dollars and invests them in US Treasury bills. The exchanges get the digital currency their customers want, and Tether keeps all the interest.
So Tether is like a wholesale supplier to the crypto industry.
Right, but here's the beautiful part. They're a wholesale supplier that never pays interest on their inventory costs. It's like running a bank where you take deposits, invest them in government bonds, but never pay depositors anything.
That's an incredible business model if you can get away with it.
They haven't just gotten away with it. They've scaled it to $157 billion. And today, Tether holds around $127 billion in US government debt, making it one of America's biggest creditors.
Wait, so this private offshore company is one of the largest holders of American government debt?
Yes. And here's where your head really starts spinning. With 150 employees making $13 billion annually, they might be the most profitable company per employee in human history.
The math on that is just broken. But surely the US government has problems with a private company issuing digital dollars that criminals love?
You'd think so. For years, it looked like Tether was heading for a regulatory showdown. The Biden administration regularly criticized digital currencies for enabling crime and sanctions evasion.
And with the return of Trump?
He came back and completely reversed course. In July 2025, Trump signed legislation that doesn't restrict companies like Tether. Instead, it celebrates them.
Wait, what?
The White House announcement was unambiguous. Quote, "By driving demand for U.S. treasuries, stablecoins will play a crucial role in ensuring the continued global dominance of the U.S. dollar."
So the same technology that enables industrial money laundering has now become official U.S. policy for continued global financial dominance?
It gets more surreal. Trump and Melania both launched their own digital tokens, coins that trade on the same infrastructure now carrying billions in laundered funds. The first family literally joined the game.
The people who are supposed to regulate this technology are now minting their own versions of it?
Yep. While investigators were still mapping criminal networks that use the exact same systems, the cognitive dissonance is spectacular.
So what's the actual strategic calculation here? Why would Washington embrace something that's obviously enabling massive crime?
Pure realpolitik. Tether operates where American banks can't reach: African villages, Asian markets, regions beyond traditional oversight. Every digital dollar issued means another treasury bond is purchased. It's another extension of American monetary influence.
Dollar imperialism through the back door.
Exactly. But it gets better. Or worse. In January 2025, Tether relocated its headquarters to El Salvador, placing one of the world's most important financial entities under President Nayib Bukele.
The guy who calls himself the world's coolest dictator?
That guy. You might remember him for his mega prison where Trump is now deporting immigrants. Somehow, this makes him the perfect landlord for a shadow banking empire.
So one of America's biggest creditors now operates under a dictator's protection?
With minimal oversight, no meaningful anti-money laundering enforcement, and a leader who's systematically dismantled democratic institutions. It's regulatory arbitrage at its most audacious.
But surely there are adults in the room pointing out that this is insane.
That's the crazy part. The adults have convinced themselves it's strategic genius. Cantor Fitzgerald, one of Wall Street's most prestigious firms, now manages Tether's $127 billion in Treasury holdings. When their CEO became Trump's commerce secretary, he dismissed money laundering concerns by saying it's like blaming Apple because criminals use Apple phones.
That's not really the same thing.
Not even close. Apple phones aren't designed to circumvent financial regulations, but that metaphor reveals how traditional finance now views Tether as infrastructure too important to regulate out of existence, regardless of criminal applications.
So from a compliance perspective, how do you even monitor this?
You largely can't, and that's the problem. Traditional transaction monitoring assumes money moves through regulated institutions with clear intervention points. Tether represents a parallel financial system that touches regulated institutions at entry and exit, but operates beyond visibility in between.
Like watching the highway while criminals use private aircraft.
Perfect analogy. A money launderer can walk into a crypto exchange in Lagos, convert $100,000 to Tether, transfer it to Singapore, convert back to local currency, complete the entire cycle in under an hour. The entry and exit might trigger alerts, but the crucial middle movement, where money actually travels, remains invisible.
And most compliance teams don't have tools to see cross-chain flows?
Especially in emerging markets where much of this activity concentrates. Meanwhile, nearly half of all digital criminal activity happens on something called Tron, a network most compliance teams have never heard of.
So the criminals have found the perfect jet stream, and most investigators don't even know it exists.
Right. According to blockchain analysts, $19 billion in criminal Tether transactions happened in 2023 alone. That's more than the GDP of most countries, flowing through systems designed to be invisible to traditional oversight.
And what's Tether's response to this?
They launched their own compliance theater, something called T3, with 20 to 30 investigators working to stop illicit flows. Sounds impressive until you realize Tether brings in 40 million new customers every quarter. Major banks employ thousands of compliance officers for much smaller customer bases.
So it's like claiming you can police the entire interstate system with 3 patrol cars.
And Tether's CEO treats compliance like customer service rather than legal obligation. He says they, quote, tend to not work with tyrannical countries' law enforcement. But financial institutions aren't supposed to choose which laws they follow based on political preferences.
That sounds like someone who thinks they're operating beyond traditional sovereignty.
Which, in many ways, they are, and that's the fundamental problem.
So we have a system that's simultaneously enabling massive crime while supporting American geopolitical objectives?
It's the perfect criminal innovation, a system so useful for legitimate purposes that its criminal applications become acceptable collateral damage. Tether enables remittances for families where banking fails, provides currency stability for small businesses in hyperinflation countries, facilitates trade where correspondent banking has collapsed,
But also enables Ekaterina Zhdanova to run a global money laundering operation from a Moscow skyscraper.
and helps romance scammers in Southeast Asian compounds demand payment exclusively in Tether, and allows ransomware groups to quote prices in digital dollars.
Speaking of, what happened to Zhdanova?
She was arrested by French police in December 2023. For investigators, it was vindication. For the criminal networks, it was just another operational adjustment. The infrastructure remains intact.
And Tether's profits keep growing.
They reported $4.9 billion profit in second quarter of 2025 alone. Every month, billions more flow into Treasury bonds, strengthening their position as America's shadow creditor while expanding infrastructure that makes crimes like Zdanova's increasingly simple.
So the system that enabled the crime is now more profitable and more protected than ever.
That's the terrifying genius of it all. Tether has achieved something unprecedented and ironic, making the United States dependent on infrastructure actually designed to circumvent U.S. oversight. Every Treasury bond Tether buys makes money harder to regulate. Every criminal transaction becomes easier to overlook in service of the U.S.'s larger strategic goals.
So what does this mean for compliance teams watching all this unfold?
First, understand that traditional frameworks assume money moves through institutions you can monitor. That assumption is breaking down fast. When someone converts cash to Tether and starts moving it across blockchain networks, it disappears from conventional surveillance.
So then what red flags should you watch for?
Sudden cash deposits linked to crypto exchanges, clients wiring funds to platforms that specialize in Tether, rapid cross-border transfers that look too clean compared to customer profiles. But here's something actionable. Expand sanction screening to include crypto wallets. Wallets and stablecoin transfers can breach sanctions just as easily as bank wires.
So treat crypto wallets like bank accounts?
Exactly. There are databases of sanctioned wallets, OFAC lists, EU lists, and compliance teams can integrate these feeds into transaction monitoring. When a client interacts with a tainted wallet, it gets treated like a normal sanctions hit.
That sounds manageable. What about the bigger picture?
We're watching the emergence of a parallel financial system that governments have decided is too strategically valuable to properly regulate. The criminals have already adapted. They're using infrastructure that Washington now considers essential for maintaining global influence.
This has been kind of disturbing, in an enlightening kind of way.
Right? The story that started with a traffic stop on the M1 reveals how quickly criminals adapt to new technology, how effectively they exploit regulatory gaps, and how they can hide in plain sight when their activities serve larger political purposes.
And how the same systems that democratize finance also democratize financial crime.
Most importantly, it shows that the line between innovation and crime isn't as clear as we pretend. Somewhere tonight, someone's getting a message with coordinates for a handover. Money will move from the physical world into the digital realm. But this time, the system facilitating that transfer won't be underground. It'll be officially sanctioned and politically protected.
The shadow has emerged into the light and been embraced as policy.
And that's our show for today. Thanks for joining us on RegTech Real Talk.
If you enjoyed this episode, subscribe and share it with anyone who needs to understand why the house always wins, especially when the house is also the bank, the currency, and the government's biggest creditor.
I'm Jamahal.
And I'm Charlie. Until next time, keep asking the uncomfortable questions, because that's where the real stories live.